Hi, Tarun. Can you hear me? Can you see me? Great. Yeah, I can see the screen. Perfect. Hi. So I think we have our viewers joining in. I would just request everybody to give us a minute to start. Tarun, so we will follow the same process as last time. We are live on this platform. We are also live on LinkedIn, and we are also live on Facebook. So how we'll proceed is that when you start with the presentation, I will note down all the questions in the comment section, and we can look at them in the last 10 minutes.
Perfect.
Right? We'll start another 1 minute. We'll just let others join in as well.
Okay.
Thank you everybody for your patience and taking out the time this Saturday to spend it with us. Okay, I think we have a good audience to begin with. So, welcome everyone. Thank you for joining in today. I'm sure you're very excited to know more about the errors that you can avoid in GST and in terms of CS. We are actually being helped by AKGVG and Associates. They are a firm of experienced professionals offering accounts, taxation, business advisory, and support services to a wide range of businesses and individuals. AKGVG also helps provide cost effective, high value solutions to meet all your financial needs. They work efficiently to get to know you and your business needs so that they can deliver timely, correct advice, helping you to improve your business and your wealth. And with that, I would like to invite Tarun to the forum. Hi, Tarun, how are you doing?
Hi, Vipul. I'm good. How are you?
I'm good as well. Thank you so much for taking out the time, and thank you for coming up with this really interesting topic. We have a lot of startups in attendance already, so I think you might have a lot of questions today, and I can already see there's a lot of people who might be excited to know more about what you have to share with them. So with that, I leave it to you. And once again, thank you so much for taking out the time on this Saturday and spending it with us. Over to you, Tarun.
So, thank you so much, Vipul, for the wonderful intro and sharing space. It is a little details that are vital. Non-adherence or adherence are to such little things will make big things happen. I think with this thought, I wish everyone a very energetic good afternoon. I'm pleased to introduce myself. I'm Tarun Kapoor from AKGVG and Associates. I feel honored to have the opportunity to make you aware about how we can save ourselves from the unwanted demand notices from the tax authorities or unwanted issues that may arise from the errors in GST compliances that are committed knowingly or unknowingly. Escaping from small obligations today might one day turn into the hardship and heavy penalties. Someone says very rightly that what cards you have doesn't matter. What is important that how you play it with. As you might have excellent cards, but you lose because of your idiocy, or you might won even though you have a terrible cards with the excellence. So it is the entity who has to decide as to which way to choose. It's either to comply now or pay for non-compliance tomorrow. So keeping in mind that under the present GST regime, taxpayers are not, please keep this in mind, that under GST regime, no one is allowed to file the revised version of the return. Once you file, that return will be the final one. So let's get started with our topic today, salvation from GST error. Moving on to the first point, that is considered insignificant, but it carries due importance. So there is a myth in the market that filing of return will be obligatory only when you have business. No, absolutely no. Someone feels that if they have business, if they have output supplies in a particular month, then only they have to file the return. No, you have to file the return even though you have a zero supply in a particular month or a tax period. So return shall be regular, be it it's a quarterly one, quarter one, which is GSTR 1, or a regular one, that's 3B, or GSTR 1, which having a monthly taxpayer. So GSTR 3B and 1 will move as per the law, not as per the business. So whether you have business or not, you have to file return. In case in a particular tax period or a month you don't have any liability, so please file your nil return, else the penalty shall be imposed on you, and the maximum penalty is 10,000 per month. Along, my next point is non-filing of GSTR 10. Whenever we talks about GST return, then everybody speaks about GSTR 3B and GSTR 1. GSTR 3B and GSTR 1. It's a monthly, it's a quarterly, it's a monthly or a quarterly. Nobody talks about GSTR 10. When you go to the extended version, then the person says might be GSTR 9 is also a return. The most expensive version is GSTR 9C is also a return, but GSTR 10 is also there. Once you surrender, once you cancel your GSTN, GSTR 10 shall be in the picture. GSTR 10 shall be filed within the 3 months of the date of the cancellation. Please check if any of your if any of your GSTN has been surrendered in any of the states. Have you filed your GSTR 10 or you are exposed to the penalty? So it's a return. Basically, what is the GSTR 10? It's a return to show the final liability up to the date of cancellation. So I mentioned that registered person is required to declare the final GST liability and adjust the same with the ITC available in GSTR 10 up to the date of cancellation. So up to the date of cancellation, I have to file whatever my pendencies are, need to set off with my ITC and give the final shot to the government in the form known as GSTR 10, that is 10. Moving further, non-disclosure of ITC reversal and ineligible ITC. Let's suppose, let me classify and we'll discuss in brief. There are three type of ITC. First is eligible, second is ineligible, and third is ITC which is eligible but shall stand for reversal with some reasons. So let me take example. Let's suppose you purchase one laptop. Laptop is furtherance of business. You are using for your business. So that is the eligible one. So when you purchased your laptop, whatsoever amount GST has been charged by the that seller, the ITC is eligible to you. Second, now you purchase car. Car is ineligible. So if you purchase any of your car, then ITC of that car is not available to you. So that's categorized under ineligible ITC. The third one is, let's suppose you purchase the furniture. The furniture is a fixed assets. So the government says if the something is the capital assets as per your books, the same shall be stand as capital assets in the GST. So you can take credit subject, you must hold that property for next 60 months. That means 5 years. If you sold your property if you sell your property before 5 years, then you have to reverse the credit proportionately up to 60 months. So basically, my point is, If ITC is divided into three parts, but what consultant do, they don't operate it separately. They just do knockoff. They said 100 rupees ITC eligible, 60 rupees is stand for reversal. They just put it net off, and there is a head all other ITC, and they put 40 rupees in that, which is absolutely wrong. They have to put 100 rupees in all other ITC. They have to put 60 rupees in ITC reversal, and then that knockoff is 60. Sorry, 40. And in the same way, if there are something which is not eligible to you, which I'm explaining in my next slide, which is not, I just mentioned even a name, a car. If you purchase car, if you have done any expenditure on food, if you are done repair expense, if you are making expense on your office building, these all are the ineligible. So ineligible has to be reported separately. Please check your returns. Whatsoever, whosoever so filed this, they might have this error. If you had already done this, so please check, please make a checkpoint. And from now onwards, please don't repeat that mistake. Put it in all other ITC, all other ITC, put it ITC reverse properly. And if there are ineligible, then put it in the ineligible column separately. So
Tarun, if I can just add in one point here. So for all the viewers who are on VidPhone, and if you want to see the presentation more clearly, please click on that screen. It will zoom in so you can have a better view of the presentation that Tarun is sharing right now. Everybody else who's on YouTube, Facebook, and LinkedIn, we will also be sharing the recording of this post the session, and the PPT will also be available for you to go through, and you can obviously reach out to the speakers post the discussion. Sorry, Tarun, just wanted to remind everybody about that. Back to you.
thank you. So I missed out. Okay. So correctly report. We should correctly report our ITC availed, ITC reversal under correct heads while filing GST returns in order to avoid any litigation with the department in future. Next is that additional place of business. Now, it is very common. Let's suppose due to this corona, we have to maintain the social distancing in this pandemic. So some people do take the additional place of business for setting of their employees. So what they do, say they are on the fifth floor, so they take on rent on the third floor or on the fifth floor, on the seventh floor, an additional place, and to maintain the distance, they shifted few employees to that place. That other place is your additional place of business. Now what consultant asks, now if you ask from your consultant what the consultant do, they said this is not your additional place of business, please don't worry, because you're not issuing any invoice from that place. No, any place which is adding to your business is your additional place of business. Let's suppose if you're not adding or you're not updating that place in your RC, then you might not be able to claim the rent expenditure you are paying or other expenditure you are paying. The ITC of all those expenditure are lapsed, because government says I don't know that that place belongs to you and or any other body, because you haven't updated on your GST portal. So if you have taken any additional place of business, that the same shall be within 15 days have to be reported to the government and update your RC accordingly. By that, there must not be any disallowances or there must not be any revocation on you. Continuing further, I am taking this very clear version of ITC. Let's suppose you have ITC. Now, whether the ITC be eligible or not eligible. So first you have to check whether the same is belong to 17.5. That means, is this a expenditure related to food? Is this expenditure related to car? Is there expenditure related to the personal consumption of employees? Or there are so many lists which specified by section 17.5. If I'm out of those, then what are the primary four conditions which make me eligible? First, I do have bill, service or goods must be rendered, tax must be paid, and return must be filed. Now, what is the glitch? Let's suppose uh, you have two vendors, A and B. A is the person. Now, I already cleared there are two returns, 3B and 1. I am trying to put the light on the flaws which is currently in the market in the GST regime. can take, the word is mentioned that return has been filed. The return has been filed means if the return has been filed by my vendor, that automatically update on my 2B and sorry 2A, and I can take from my 2A. So I have to take input whatsoever is 2A is 2A. A means automatic, GSTR2 is a form. So automatically whatsoever uploaded on the GST portal, I can take maximum 10% with grace. With grace of 10%, I can take my ITC. If I have 100 rupees expenditure and my 2A is of rupees 80, then I can take maximum 88 rupees, irrespective of my books. I cannot go beyond my 2A. So I was trying to explain there are two vendors A and B. Let's suppose A is very genuine and A is ready to file. Now, I think I should clear before putting this example. We have to pay tax with the form 3B, and GSTR1 is a outward sale return, in which we have to file a return without any payment, because payment we have to do on the 20th of the every month, and which is through 3B. So, and now A is a very genuine person. He want to pay to the tax to the government, and he pay through 3B, but he forgot to file GSTR1. Now, government says tax must be paid. Tax has already been paid. Government says return has been filed, but government doesn't say that return has been filed with which. They said GSTR1 shall be filed, that shall be auto-populated in 2A, and that we deemed as the tax has been paid. No, GSTR1 doesn't link with the payments, and 3B is linked with the payment, but the 3B doesn't have the capacity to update 2A. So in the case of A, even I paid my taxes to that person, he paid to the government, even though I cannot take the credit just because 2A is not updated. Let's suppose the B, who has a malified intention. He knows this everything, that though I don't pay to the government, I can take other person in a comfort that yes, I paid the taxes. He will file GSTR1, that is auto populated in my 2A, and I can take credit. So there is a flaws. I think either 2A is not proper authentic, that that person has paid the tax or not. Either 1 or 3B shall be linked, that if the person has not paid the tax, he cannot file GSTR1. So this is the flaws. So again, I'm repeating conditions. There are 4 conditions. You must have invoice, goods or services must be rendered, tax must be paid, and return has been filed. What maximum amount of credit you can take apart from ineligible? I'm talking about the eligible one only. That eligible one, you can take credit up to the 110% of the 2A. So we have to check each and every month whatsoever in our books, what is available in 2A, maximum the capping of 10%, and we have to take cumulative. Now, please ensure in the March that 10% grace is not there. Yes, from April to March, government is saying 10% leverage is there. But up to March, we have to see that 100% and 100 shall be our 2A. So we need to chase our vendors again and again if they have not filed the return. If we can see there is a huge gap between our books and the 2A, then invoice level reconciliation shall be there, and we have to ping to the vendor that please submit your return, please file your return. So the registered person should comply with the conditions for claiming ITC. Otherwise, there would be requirement to reverse wrongly availed ITC along with interest, which would increase the financial burden of the entity. Next is updating mobile number and email IDs. Now, this is very common. This is very common when companies having its legal entities or their tax departments. Normally, what do HOD or any other person who is a very what we can say is an authorized person. The authorized person put his own mobile number and email ID while taking the registration. We must be aware and we must ensure that that person is viable enough, because first level communication by the department is through mobile number and the email IDs only, our first notices or any other demand or whatsoever it is. So if that person leaves your organization, you immediately change your email ID and mobile number of that person, updated on the portal. By that, there must not be any problem in future. So in case there is any change in the existing authorized person, any change, new details must be updated in as early as possible. Otherwise, any update from the department would go in the previous email address and mobile number. And I'm sure once he left the organization, once he will not be associated. Let's suppose he will not be associated with you. He will not give you any OTP or means that might be the nightmare for you guys. So it caused loss to the taxpayer due to the non-recipient of the information on a timely basis for responding. That might be that will be the repercussion on you. So updating the details must be done as early as possible in order to avoid any hassle in future in relation to the receipt of communication from department. Next is non-reporting of documents, issued details and HSN. Look, when it comes to invoice series, then you can take any invoice series. Let's suppose if you want to have your 5 invoice series, multiple invoice series you want to have a 3 invoice series, you want to have a bill of entries invoice series is different as compared to tax invoice, you want to have export invoice series is different with your DTA sales. Government is allowing you, but government says that each and every series has to be reported in the return. As many as series you have, doesn't matter. But please report in every GSTR1 that first invoice issued in that month and the last invoice issued in that month. Total, and then put number of cancelled invoice and put the total remaining invoices. Same as the with HSN. Now HSN is mandatory. So you need to put HSN in GSTR1, that HSN, the code or SCN. If you are a service provider, then SCN, or if you are a manufacturer or you're a goods provider, then HSN it shall be there. So you have to put that HSN in GSTR1. The taxpayer should report these details as these details are mandatory to provide, required to report it in GSTR1. So these are the normal salvations from GST errors. I just put the light on the penalties which imposed by the government if you forgot to, or if you have omitted this to follow. If you are omitted to file NIL GSTR return, then 10,000 rupees per return. Non-filing of GSTR 10 is the maximum late fees of 10,000. Non-disclosure of ITC, maximum penalty 50,000. Additional place of business, if you're not updating in RC, maximum penalty is 50,000. And non-reporting of detail issued in HSN or invoice series, then its penalty will be 50,000. So with this, doing this little things, right, will precaution will save us from the unwanted penalties, I guess, and lack of it will financially burden the entities. With this, I conclude my presentation. Thank you everyone for lending your ears and patient listening for this session. Without wasting your time, let's move to the Q&A session. Please ask your queries. Would like to answer to the best of my knowledge. Please.
Tarun, thank you so much. That was very, very insightful and on the dot with respect to the time. So, thank you so much. I have a lot of questions that have come up. I have tried to select the initial ones that came up. So, the first question
Please.
is by Janki. She's
Hmm.
from Silverleaf Interactive. Her
Hmm.
question is, which of the existing taxes are proposed to be subsumed under the GST? So basically, which of the existing taxes are supposed to probably, come under the GST fraction?
There are 17 taxes which are subsumed by GST, and there are few taxes left. Let's suppose if I'm talking about VAT on petroleum products and stamp duty value. Now BCD is also there. Excise was subsumed. Custom, the other part of the custom is there. The basic part, which counterfeiling part of VAT and excise was subsumed. So I can share the list. There are 17 total taxes which are subsumed by GST. So I can share the list.
Great. So I think what we'll do is post this call when we share the presentation, we can probably share that as an add-on to the presentation as well. Thank you, Tarun. Thank you, Janki, for asking that question. The second question is from Aditya Raghav, Juvo Online. He asked, what is dual GST and why is dual GST required?
Dual GST is just a concept, is just a replicate of VAT. That means you can take, let's suppose I bought something of rupees 100, that I need to pay tax on rupees 100. I just add on this. My now for my finished goods is of rupees 130. I'm selling the goods on 130. I have to pay to the tax on the 130. Now 130 tax on 130 and whichever I already paid on 100 can be subtracted. Now if my outward liability is rupees 20 and my inward liability which I already paid is rupees 18, so I need to the pay to the government only 2 rupees. So this concept was followed even earlier when during the VAT, and we are just copying the same. The even excise and service tax was on the same path.
Great. The next question that we have is from Mukesh from Musu Technologies. What would be the role of GST Council?
GST council always plays a role like you have, so if there is a due date is not extended, there are so many things, there are so many problems facing by each one of us, then GST council is the authority to whom you can approach. Now there are so many, see presentation from federal department, you can see from the ICI, and so they all taken to the GST council take care of this all problems.
Great, very interesting. So the next one is by Vivek R, webcreators.in. What are the benefits available to small taxpayers under the GST regime?
Small taxpayers, again, there's a definition of small taxpayer, I don't know, but yes, as per GST, they divided into, if your turnover is less than 5 CR, you need not to file your 9C. That means you need not to do your audit. So 9C audit requirement is apart. If you are so small, less than 2 CR, then you need not to file even GSTR 9. If you are less than that, no might your GSTR 1 falls into the quarterly return. So as they are starting from the scratch. If you are very small, then please return your file your return quarterly and then move accordingly. Or if you are if you are if your turnover is increasing right now, then you can file monthly. Then you further increase, then GSTR 9 is applicable. If you further increase, GST 9C is applicable. So, apart from these threshold limits, there is no specific guidelines or there is no specific benefit given to the GST, small GST taxpayer, as we saw in the earlier tax regimes.
Got it. Got it. Thank you so much for the insight. The next question that we have is from Mr. Pradeep Hota. He's from hobbypot.com, founder of hobbypot.com. He asks, how will imports be taxed under GST?
Pardon?
How will imports be taxed under the GST?
His question is about imports, correct?
Yeah. How will imports be taxed? Yeah, imports.
Basically, under import, still custom is working. So earlier, along with the custom taxes, there was a manufacturer taxes of excise, the countervailing duty of excise, countervailing duty of VAT. What was in the earlier regime? They said if the person is manufacturing into India, then excise will be applicable. If the person is selling into India, then VAT will be applicable. So, what was the methodology? That if you importing anything, then apart from custom, you have to give countervailing of excise, which is the person who is manufactured in India, the countervailing duty of VAT, the person who is selling in India, and the total taxes by the Indian manufacturer and the person who is importing is on the same path. Now, after GST into the picture, the countervailing duty of excise and VAT has been removed because there is no countervailing part. There is no excise and VAT in the India. So there is only a countervailing part of GST shall be there. So now they did after custom duty, they just imposed the IGST, which is the same part which is applicable in India. So again, on to be on the same page, the Indian manufacturer and the person who's importing, they are imposing custom and then GST.
Got it. So the final question that we have is from Sri Raghavan, from founder of Biz Sciences. He says, how are the disputes going to be resolved under the GST regime?
Okay, so
You always get those googlies at the end.
okay, so disputes. The system is still same. Hierarchy is still same. We don't have the new department of GST. There is only a migration of sales and excise department. So earlier we used to go to the assessing officer. That the name nomenclature has been changed. Now you have to go to the proper officer. Proper officer will strictly follow the law. So he will stick on the law that these are the law, and if you are adhering the law, please tell me. If you are not, then he will issue the order. Once you you will get the order of disc of non-compliance, then you can apply to the next or the commissioner assistant, then assistant level, commissioner level, and the move on. So the resolution is still same. You have to follow the hierarchy which was earlier in the place.
Got it. Got it. So yeah, so that's the final question, Tarun. Thank you so much for your time. A very insightful session again. And I am getting still more queries. So what I'll do is I'll pass on some of them to you, and we'll also share the presentation again. Thank you for taking out the time. I know you're a busy man, even on a Saturday. So thank you so much, Tarun.
Thank you so much. Thank you. I'm just passing on to the MC errors to the Neetumar. Please.
Hi, Neetu. Can you hear me?
Yeah, I can hear you. You can hear me?
Yes, I can hear you clearly, Neetu ma'am. Thank you so much for taking out the time on this Saturday. We've already had quite an interactive session with Tarun. So what I'll do is I will let you start, and the process is that we are as of now live on Facebook, LinkedIn, and a couple of other channels, including this. So all the queries that come, I will select them. I will keep them ready, and I will ask you those questions in the last 10 minutes after you're done with the presentation now. And also for everybody's sake, if you guys like to make sure that you can see the presentations clearly, please click on the window with the presentation so that it zooms in for you. You can see all the details there. So again, everybody, thank you so much for taking out the time this Saturday. And with that, Neetu over to you.
Okay. Hi everyone. I am CS Neetu Saini, and I am here with the perspective of knowledge sharing about the various important amendments under the Companies Act over the last 1 or 2 years, which are generally neglected by us due to lack of knowledge or lack of time. One more thing which I have observed, professionally and direct professionals and directors are common more concerned about the income tax and GST. However, MCA or ROC compliances are equally important. After incorporation of the company, we forget to do other compliances. In 2017, ministry has taken major steps like blocking of DIN numbers of directors who have disqualified due to non-filing of annual returns. And like ministry has also done strike of the shell companies in which non-filing return companies were identified as shell companies. So in my presentation, I have covered some of important topics which is very important for startups and other companies as well. Let's start from commencement of business. I have started from commencement of business. There is a reason. A company incorporated after commencement of the Companies Amendment Ordinance 2018, that is 2nd of November 2018. Having capital shall not commence any business or exercise any borrowing powers unless a declaration is being filed by a director within a period of 180 days from the date of incorporation of the company in form INC 20A and verified in such a manner as may be prescribed with the registrar that every subscriber to the memorandum has paid the value of the shares agreed to be taken by him on the date of making of such declaration. The motto of this section or this form is generally people incorporated company and they don't deposited subscription money in the bank account and they invite subscription from the outsiders like public. The motto of this section is first deposit your subscription money in the bank account of the company, then invite public subscription. In case of a private company, also it is now mandatory to have a certificate of a commencement of business. If you not filed Form INC 20A with the attachment of bank statement in which you have deposited the subscription money, there is a penalty provision also, that is 50,000 on the company and rupees 10,000 per day on the officer in default, you can say. That can be up to 1 lakh rupees. It is a discretionary power of a ROC that he can remove the name of the company from the register of company. If you not filed commencement of business after the incorporation, that the ROC have a discretionary power to remove your name from the registrar of companies. So you have to take care of this compliance after the incorporation if you are missing, which is very, very important nowadays. I'm moving to the next topic, that is exempted deposit. The Ministry of Corporate Affairs, via its notification dated January 22, 2019, has directed every company to file e-form DPT3 except the following. These three companies have exempted to compile this provision. There is a reason I will explain you later on. The exempted company is government company, non-banking and finance company, and banking company. Government says that ki I'm following all the guidelines, that's what I will not file this form, that's why he is exempted. Non-banking company is the routine business of accepting deposited or giving the loan. So that's why banking company is exempted to file this exempted deposit reports. Before January 2020, 2019, only the company who accepted the deposits were required to file a return of deposit in e-form DPT3 by furnishing the details of deposit. That means before 2020 January 2019, only public company or company which is accepting deposits were required to be filed. But now every company, means including private company also, needs to file a one-time return and yearly return for exempted deposits. Now question here is ki what is exempted deposit? There are number of transactions which can be identified as exempted deposit, and it is duly written in the covered under the rule 2 sub rule C of the company's deposit rule, acceptance and deposit rule 2014. I can give you an example or 2-3 transactions. What kind of transactions you can say it is exempted deposit? One transaction which mostly occurs in the company, an amount received by a company from any other company, you can say under inter corporate deposit, which is covered under the exempted deposit. Any advance for the supplier of goods or provision of services counted for in any manner and within a period of 365 days from the date of acceptance of such advance shall be treated as exempted deposit. If such kind of advances you have in your books on 31st March of any financial year, then you have to report in DPT3. Now, requirement of this filing is every year. Due date of this filing is June 30th of every year. Now in this year, because of COVID, it has been extended to 31st December 2020. You can file your DPT return by 31st December 2020 because of COVID. Otherwise, from the next year onwards, you have to file this return to January 30th. Information to be furnished. What kind of information you have to furnish in this particular form? Let me explain you. Total outstanding amount of exempt deposit at the end of financial year is needed to furnish in yearly return. That means you will compile all the transaction which is covered in the exempted deposit. You will total it and fill in the e-form DPT3. Now there is a question in which you need a CA certificate. Okay, what is exempted deposit, like authentic certificate? The answer is yes. If you are filing return for deposit, then you will be requiring a certificate. Otherwise, for the exempted deposit, you will not require any CA certificate to be attached in form DPT3. Now again, I again come to the penalty part. In the every section of Companies Act, there is a penalty part. If you see the compliance, then you will think we will fill this return later on. If you will see the penalty part, then it is very huge and you will go on time on every return. There is one more thing here to discuss. Such companies are not required to file any return. Even nil return is not required to file. If there is no transaction in your company related to the exempted deposit, then there is no need to file nil return. That means if you have any exempted deposit, that only you have to file the return, otherwise not. We'll come to the punishment part. Punishment for non-compliance on the company: a fine of rupees 1 crore or twice the amount of deposit so accepted, whichever is lower. For example, you have accepted 2 crore of deposits and minimum 1 crore is here. Whichever is less, the ROC will impose you 1 crore penalty, which may be extended to 10 crore. On the officer of the company who is in default, there is an imprisonment up to 7 years and with a fine of less than rupees 25 lakhs, which may be lower. Now, if you will see that a little form, if you will file on time, so there will be no plenty provision. Otherwise, 1 CR is a very big amount for penalty provision, and there is a imprisonment also up to 7 years. So better is to file returns on time. Third part, which I will discuss here, that is director's KYC. Every individual who holds a director identification number as on 31st March of a financial year shall submit e-form DR3 KYC or KYC web, as the case may be, for the said financial year to the central government on or before 30th September of immediate next financial year. If the director fails to compile with KYC, then the DIN of the director will be deactivated. Some of the director are not aware about the KYC every year. When he start filing return of MCA, then he will find that my DIN is deactivated. Why it is deactive? The only reason is if you are not filing your KYC annually, then your DIN will be deactivated. If the director wishes to reactivate his or her DIN, the same can be done filing e-form DR3 KYC or KYC web bills, as the case may be, with a penalty of rupees 5,000. That means if you forget your KYC on time, then you can do it later on, but with a 5,000 penalty. What is the impact of DSC or DIN KYC? That is, if every company is required to file the annual accounts in AOC 4 and annual return MJT 7 as per the Companies Act within 30 days and 60 days respectively from the conclusion of the annual general meeting. That means if you are closing your balance sheet or profit and loss account every year, 31st March, that after finalizing the financial statement, you have to file AOC 4 and MGT 7 every year. Here, irrespective means AOC 4 you have to file in within 30 days from the date of annual general meeting, and MGT 7 within 60 days from the date of annual general meeting. If fails to file, company can file AOC 4 after 30 days of AGM, but after the penalty of additional fees of rupees 100 each per day. That means if you are not filing your AOC 4 financial statement with the ROC, then you can file after the due date, but with a penalty of rupees 100 per day. Same is with MGT 7. If you fails to file MGT 7 after 60 days of the AGM, but after the payment of additional fees of ₹100 each per day. Again, a penalty part here. What is the effect of non-filing? There is a penalty provision also, and according to the section 240A subsection 1C, ROC will resume that your business is closed because you have not filed AOC 4 and MGT 7 for continuous period of 2 years. So registrar of companies will send a notice stating his intentions to strike off your company. After providing reasonable opportunity of being heard, he may strike off your company or provide an opportunity to file pending returns. That means it is again a discretionary power of ROC. He may close your company, he may give you opportunity of being heard, he may give you opportunity to file your returns and start your business again. On directors, what will be the impact of non-filing? I have discussed 248. This is the impact on company. Now, non-filing impact on directors. According to the section 164 subsection 2, if your company has not filed AOC 4 and MGT 7, for continuous period of 3 years, director of the companies are disqualified to be reappointed in that company or appointed in another company for 5 years. That means if you are not filing return of any company in which you are a director, then it will be a problem to you for another companies in which you are a director. For example, if you are a director in a limited company and you have defaulted in filing returns of such company, then you would not be able to reappoint somewhere else or in its company also, and your DIN will be blocked for 5 years. And you cannot incorporate a new company with this DIN. Now the people will ask to me that we will make new DIN. It is not possible to have double DIN or multiple DIN on the same time. You can carry only one unique DIN number, like a PAN number. You can have only one DIN number. Next, disqualification of director. Now understand what is disqualification under section 164 subsection 2. Company has not filed financial statement annual return for any continuous period of 3 years. If you are not filing return for 3 years, you will become disqualified. Another one thing is important here. Company has failed to repay the deposit accepted by it or pay interest thereon, or to redeem any debenture on the due date, or pay interest due to thereon, or pay any dividend declared, and such failure to pay or redeem continuous for 1 year or more. For example, if a person is a director in more than one company, for example in 4 companies, one of such company A, may default under section 164 subsection 2. The name of company may or may not be struck off from the register of the ROC, but such director will become disqualified. That means company may or may not be struck off by the ROC, but director will definitely become disqualified because he has defaulted to file the annual return. In such case, if that disqualified director filing any form in other company, that is in B company, in C company, in D company, then an error is occurring that the person associated with the DIN is disqualified and not allowed to file the form. That means you are blocked from everywhere. In company A also, in company B also, in company C also. Therefore, by this practical problem, one can opine that intention of the ministry is that once a director is disqualified under section 164 subsection 2 subsection A, he have to vacate the office from all the companies in which he is acting as director as a vacation under section 167 subsection 1. Now, nowadays, number of directors are disqualified. Identify the MC portal. and they have to file a writ petition to the High Court for the removal of their disqualification. If your company is striked off due to this disqualification, there is another problem. You have to go for the revival of such company to the NCLT. From NCLT, your company will be revived, and then you will file the pending annual returns, which is a very costly procedure. And for annual filing, you have to pay 100 rupees per day on per form. If you file two form, that is our AOC 4 and MGT 7, then you have to pay a huge amount of penalty on filing. But the ministry has launched a scheme, CLSS, company law scheme, in which you have a relaxation of filing fees till 31st December 2020. If your filing is pending in any company, then you can get the benefit of such scheme, which is valid till 31st December 2020. So I would suggest, if anybody is defaulting filing or KYC, so we have to update it immediately. Thank you. This is from my side.
Great. Thank you so much, Neetu, for taking out the time again. And that was very, very insightful. Thank you so much for that. I have a few questions that have come up. So the first one is a little elaborate. So this is from Arun Kumar, Big BHK. He asked, the Ministry of Corporate Affairs had issued notices to 2000 startups regarding the share premium calculations. The MCA has asked the startups to come with explanation and also about the details of fundraising transactions. What can we do to avoid being on a similar list?
We can do one thing. Every time whenever we issue shares, we have to obtain a valuation report from the registered valuer or merchant banker. Merchant banker, previously it was allowed, but nowadays registered valuer is mandatory for the buyback issue, or for preferential issue, or for private placement. So if we are taking valuation from the registered valuer, so I don't think there will be a problem or any questionnaire from the MCA side, because your projection will be there, your audited financial base would be there. So I don't think there will be a problem.
Great. And is there a set standard format for this, Neetu?
Yes, there is a standard format also, or there is a formula of valuation also, and company will provide to the registered valuer projections, etc. And he will give the independent opinion. It will be not forced valuation, that for example, if I say please valuation rupees 4,000, so he will not do that. There will be some specification, their formula, their projections. So that's why ministry has introduced an independent valuer. You can obtain the valuation report from your statutory also, statutory auditor also, but the ministry has introduced registered valuer concept, independent valuer.
Got it. Also, again, for the benefit of everybody and all the viewers, in case you have specific doubts that I don't cover right now, and if you'd want those formats, you can reach out to the team at AKGVG directly with the email ID info, that is info @akgvg.com. Right. Okay. Now on to the next question. So this is posted by Anonymous. They ask, if the valuations fall after the first round, what can a founder do?
Pardon, please.
So the question is by Anonymous. So they're basically asking, let's say the valuation of a startup actually falls after the first round of raising the investment. What can a founder do to be on the right side of things?
As per my understanding, if you are issuing shares, so in private placement, you know the investor, that is a group. Private placement means a group of person you are issuing shares. Then obviously you have to identify the valuation first, then you will allot the shares. Otherwise, what will you write in your offer letter? Firstly, if you will issuing offer letter, for 15 days or for 13 days, which is mandatory as per the law, then definitely you will find out some valuation or number of shares or number of size of issue you previously know. Then you will issue. So that I don't think this issue will come. How much valuation will come after the issuance? I think it should be prior to the issuance.
Got it. The next question that we have is from Tarun Cloudcorp. He asked, "What is company's Fresh Start Scheme 2020?"
In fresh start scheme, there are number of company which was defaulting in annual return, and they were suffering with a huge amount of penalty. For example, if you are defaulting from 2015, according to the rupees 100 per day, there will be a penalty somewhere around in lakhs. But in fresh startup scheme, you can pay nominal amount for 2015 return also and in 16 return also. That means you can file your 5 years annual return till 30th December 2020 on a nominal basis.
Got it. Got it. No, I think that's quite a prevalent problem that we have, especially with COVID going around. There might be a lot of startups facing similar issues. On the same lines, there's another question by Anonymous. So they ask, "Are there any schemes that provide benefits to inactive companies?"
Basically, this scheme is specially for the inactive companies.
Oh, okay.
Apart from this, normal companies are also taking the benefit of this scheme because this scheme is for all. So inactive companies can take the benefit because this scheme previously was till 30th September. Now ministry has also extended the date till 30th 1st December 2020. It is not for the annual filing. It is for the other form also, like MGT 7, INC 22, other directors appointment design form, because everybody is working from home. For
Hmm.
example, I have to file a form DI 12 for appointment of director in any company, and because of COVID I was not able to file it within 30 days as per the law. So ministry has given the extra time to file it for DI 12 also, not for only for the annual return, it is for all other forms also.
Great. Great. So that was the final question, Neetu. Thank you so much for your time. Thank you for taking out the time, that too on a Saturday. Thank you so much. To all the viewers, thank you again for tuning in. I hope you enjoyed the session. And for any more queries that have not been resolved, or if you have specific questions that you would might not want to ask, in the open forum here, please reach out to AKGVG and Associates. I'm sure they'll be happy to help. Once again, you can reach out to them at info, that is info, at the rate akgvg.com. Thank you, everyone. Stay safe. And thank you, Neetu, once again for taking out the time, and the good people at AKGVG and Associates. Thank you so much, everybody. I hope you have a good week. Thank you.
Thank you, Vipul. Thank you.